stocks hitting all-time highs today. And if you're starting to feel a little worried at the top, our next guest says he has the ultimate hedge for your money. Let's go off the charts with Chris Verrone of Strategas. Chris, what are you looking at?
I'm Melissa. Well, I think it's important. We're 70% off the low over 10 months. You have the Russell 2, which I think is 40% above its 200-day. I just want to be respectful of the tape and get an understanding of what some of the market's more defensive corners are trying to tell us. And when we think about defensive groups in this market, really have 4 or 5 options. We can talk about staples, we can talk about Utes, we can talk about gold or bonds or REITs. So I kind of want to take them one by one and see where we stand. We'll start with the staples. That's the first chart we brought along. The trend has been up, but they haven't been a leader. And if you look at staples making multi-year relative lows right here, I think we can kind of cross them off the list. They aren't providing any type of protection in this market. Discretionary is still better. So let's say it's not staples here. Let's move on from that one. What about the utilities? Utilities actually have been weaker in absolute sense, has not made a new high. It is also making multi-year lows. Might be a reflection of bond yields. The fact that bond yields have gone up, utilities have softened here. So our first 2 candidates, staples and Utes, both making multi-year lows. We don't think that's how you can play defense in this market. So what does that leave us with? It leaves us with bonds, it leaves us with gold, and it leaves us with the REITs. And I want to show you our third chart here. This is a look at all those defensive groups since November, since the vaccine news on November 9th. Just one of these groups, that blue line, that's the REITs, which have actually showed up and have kept their head above water over the last couple months. I think this is where, if you're eager to put some protection on here, if you're eager to get more defensive, I think this is where you can go. And if you look at where the money has gone over the last 12 months, these are the top 6 sectors of inflows over the last 12 months. I don't see REITs on this list. If you go to the next list, the bottom 5 sectors, all the way at the bottom, attracting among the least amount of money over the last year, are the REITs. And as we like to say, we don't like REITs because they're last on this list. We like the REITs because they're getting better and they're last on this list. So what names can we play here in this space? They're actually more offensive than people think. I want to focus on the mall REITs. This is Simon Property, ticker SPG. This is a stock that didn't peak in 2020. This is a stock that peaked in 2016. You had a 5-year bear market here. You've based for the last 10 months. You've broken up through $100, 105, 106 today. I think this can trade 135, 140, a nice bottom, a nice base there. And then the Resi REITs, EQR, Equity Residential, another improving name, another stock that's weakness and its underperformance predates COVID. This has been an underperformer for a long time. I think this has bottomed in a very big way, breaking out here over the last several days. This is another one, I think, in the context of wanting to put a little defense on in a defensive sector. This is a way to do it. REITs better than staples, they're better than Utes, and they're better than bonds.
Chris, it's Karen. Let me just ask you something about REITs, specifically more in the commercial office space. Is it, things I think will continue to get worse because we haven't seen leases roll over yet. Do you think this sector, though, is so bad and already pricing in just, further downside that the risk reward's compelling here?
This is another area where, Karen, I think, as you know, these office REITs didn't peak in January or February of last year. A lot of these things peaked 4 or 5 years ago. And when you're a relative laggard and you get a nasty event like COVID, you're the stocks that get punished the most. That already happened. I think that's been discounted in these names. A lot of them traded down 70, 80, 90% into the lows last March. They've spent the last year improving. I think office, along with the retail REITs, along with the mall REITs, are improving parts of the sector. Now, conversely, on the other side, the area that everyone has played in the REITs, the data centers and the towers, that's SBAC, that's American Tower, those are the ones actually rolling over here. So, much like you're seeing with the broader market, more offensive leadership, even within defensive groups like REITs, you're seeing the more offensive names take leadership as the more defensive names start to underperform.
Chris, thanks. Good to see you.
Thank you, Melissa.
Chris Verrone of Strategas. And Tim, I think that's an important point in that there is a big component within the REIT sector that is very leveraged to the reopening trade.
Oh, yeah. And the other thing that I think we all say, I know I say it probably too much, but the best returns are sometimes derived when things go from terrible to just bad. And if you think about mall property REITs, Look, were there darker days than the downfall of essentially the shopping mall period meets COVID? And so I think to the extent that Simon Property Group is now at least seeing some leverage to a reopening where a lot of bad news has been processed in terms of landlords having to break leases, renegotiate. Obviously, mall traffic, we know where it is. So I like the call. Chris always lays out a great story. And I think in the defensives, I would also look at MLPs and the energy sector, which are also, at least in some sense, maybe seen as not as defensive, but and at times have been riskier. But clearly, again, yield plays that I think right now are very much in vogue.
Bonawyn, your defensive play, your top one.
Well, listen, I think that I follow his logic in terms of this being a relative value play. Where I have a bit of a question is in terms of presenting it as a defensive play, only because we've seen so much price volatility in both the REITs and the individual properties themselves. Personally, I think if you're going to play it defensively, I still like some of the healthcare names. I still like some of the emerging market names. And I understand that they're reopening trades, but just in terms of a difference between names that have had triple-digit returns versus names that are still somewhat relatively under the radar and don't have the same idiosyncratic risk. I don't want idiosyncratic risk because I can't really model that out or forecast that. So that is kind of how I'd be positioned in terms of playing it, quote-unquote, defensively.
Shepard Smith here. Thanks for watching CNBC on YouTube.